Hi, my name is Scott Gibson with Beneath the Surface. I'm here with James West of the Midas Letter. James, thanks for being with us.
Thanks, Scott.
So I wanted to talk to you about where we're at right now in the market cycle. We've had a rough couple of 2.5 years.
It's been almost 3 years, yeah. A pretty severe down cycle. In fact, the top was in July 2011. And since then, the TSX has fallen from, at that time, high of 2450. It fell to 980 back in, well, it bounced at 980 in July 2013, got a bit of a lift, and then it bounced downward again. So, but I think what we're seeing now is the signs of a broad-based recovery. And I think that's partially due to the recovery in precious metals prices, which itself is predicated by the idea that the quantitative easing that was supposed to be bad for precious metals, well, it turns out that it's actually good for precious metals, which the contrarian crowd more or less unanimously agreed with. And why is that good for precious metals as opposed to bad? Well, the reason is the U.S. has reduced quantitative easing by $20 billion a month at this point. But it's a lot more than $20 billion a month that has been taken out of the economic equation because they were buying $45 billion a month in agency mortgage-backed securities and $40 billion a month in treasuries. Those both qualify as Tier 1 assets. So when Tier 1 assets go onto the balance sheet of an institution involved in the banking industry, they can be lent out at, thanks to the miracles of fractional banking, at a rate of up to 16 to 1 in some cases. So really reducing quantitative easing by $20 billion a month is technically lessening the money supply by up to $240 billion a month. And so they pulled back on their buying, and they've been the majority buyer of bonds since quantitative easing began, the Federal Reserve. They now have $4 trillion on the balance sheet. They have to bring that down. In response to that, China has dropped off on their bond acquisitions. In fact, in the month of January, they bought $78 billion less than the month before, and that represents the biggest decrease in Chinese bond buying since 2009, since quantitative easing began. So all this means that the bond is no longer a great investment because the interest rates are so low, and unless the United States is continuing to support that massive capital fabrication, somebody's going to get left holding the bag on what is essentially a baffed out and devalued dollar. And the purchasing power of the US dollar is suffering accordingly. In fact, you're familiar with the incident where Mohammed Al-Arian left PIMCO under mysterious circumstances, and actually it was because PIMCO has now started to lose a lot of money and they're getting a lot of redemptions. That caused friction between Bill Gross, the incumbent CEO, and Mohammed Al-Arian, who was sort of being groomed to replace him, and they actually had a shouting match in front of everybody, which was reported in the Wall Street Journal. But so I think that's why we're seeing precious metals suddenly become more sought after, especially in the East, where China has now exceeded 1,000 tons per year in investment demand. And so if the collective perception globally is that the artificial economic recovery was predicated, in fact, only by the production of US dollars out of thin air, and now that that's reversing, well, that means that there's a new emerging crisis in US dollars, and the immediate beneficiary of that is gold and silver. So our TSX venture market, being very much oriented and weighted towards gold and silver exploration and production, has started to respond favorably, and in fact we're now back over 1,000 on the S&P TSX Venture Index, and a lot of companies have doubled and tripled, especially those with higher grade, low-cost deposits that are closer to production. So where are we now? In a long-winded way to answer your question, I think we're at a very similar time to January 2009, when at that time the recovery was predicated and started and instigated and maintained. The momentum was maintained by the advent of quantitative easing. Well, now, rise in the price of gold and the recovery in the TSX venture market is being driven by the removal of quantitative easing. And so the U.S. is now between a rock and a hard place in the most profound way. There's a crisis developing in the dollar, and so I think they're going to actually have to reverse quantitative easing. They're going to have to raise interest rates. All of that is very dollar positive, especially in the face of the confidence in the U.S. dollar.
And the forecast is for that to be totally phased out by the end of this year. So do you see this in the next 2-3 months that they have to reverse policy?
I don't know if I would be comfortable stipulating a timeline for that. I mean, one thing that the Fed has taught us is that you can't trust anything they say. Because remember in June, Bernanke said, well, okay, it's time to start tapering. The market fell into a swoon in the United States, and by the FOMC meeting, there was no tapering. So, that's they're not really trustworthy. And so when they're saying that they're going to do this, the Fed has learned that whereas the market's trying to anticipate what they're going to do and what they're going to think, now the Fed is trying to anticipate how the market's going to react, and so they issue statements accordingly. And that just makes for a completely delusional setup in terms of making monetary policy and fiscal policy, and in terms of forecasting economically, even where you need to invest in your own business.
Yep. So where do you see things going if the Fed does reverse policy in regards to gold and the gold price?
You mean if they were to start quantitative easing again?
QE4, let's say.
QE4, okay. Well, I think, again, it's very hard to make predictions based on fundamentals because the ability to fabricate money out of thin air is not technically a fundamental. It should be criminal, but in this case it's not, unless, of course, you're not the Fed. And the answer is it would depend on the degree to which the policy was reversed. So, for example, if Janet Yellen just tries to return to $85 billion a month, then she's essentially admitting in a very public way that the U.S. economy is only looking robust, and the markets are only reaching new highs, and the GDP is only growing thanks to quantitative easing through the miracles of fractional banking. So if she's going to sort of stem the crisis in confidence that action on her part is going to engender, she's going to actually have to maybe double down to really say, okay, we're really going to backstop the dollar. We are going to quantitative ease, and there will be no end to it. That's the message she's going to have to send to regain the confidence by investors to start actively deploying capital again. So the answer to the question is I really don't know, and it does depend on the degree to which the policy is reversed.
And how are you playing gold stocks in light of that for 2014?
Well, I think personally I believe no matter what they do, that they're just in a bad position.
So in light of that, how are you playing junior golds?
Well, I think it's time to start buying them again, especially companies that are able to develop higher grade deposits in safer jurisdictions, are able to roll out a business plan that has contemplates a low capex. You don't want to try to build a $3 billion mine in this environment. And so there are a few companies that I especially am investing in that fit those criteria. They have to be, for me, the company now has to look like if suddenly there is a quantitative easing event that causes gold to reverse again, they have to be a company that's going to survive another 3-year downturn.
Okay.
And so for me, that's how I look at companies now, is it's got to be able to survive a 3-year downturn. We saw some companies get into real trouble. Colossus Minerals, probably the poster child. They elected not to create 43101, so when the crisis hit and their burn rate was high, they couldn't go to alternative sources of financing because nobody could value them because there was no 43101. So that tells you something. Everybody hates to do a 43101 in the corporate world because they cost so much.
Right.
And they tend to underestimate future potential. But at the end of the day, if there's going to be a financial crisis, you want to have a 43101, especially if you're burning $20 million a month.
Right. So what stocks do you like right now that sort of fall into that category?
Well, so in particular, I look for stocks that are going to have a very low all-in cost of production. And so one in particular that fits that bill, I think, is a great example is Klondex Mines, KDX on the TSX. And the reason I think that company is so great is because even if gold goes to $700, they're still going to be profitable. And the company recently, actually just February 14th, I believe it was, they closed on the acquisition of the Midas mine, which was formerly known as the Ken Snyder mine, which they acquired from Newmont. And the CEO of Klondex, Paul Hewitt, was he worked at that mine for 8 years, and so he knows what he was buying. And interestingly, Newmont was getting ready to shut it down and saying, this mine, there's nothing left here. And Paul, who had worked there for 8 years, and his general manager, Mike Doolan, they knew there was something more there, or they felt very strongly that there was. 3 days after they closed the acquisition, they drilled a 110-foot drift that assayed 200 to 300 ounces per ton silver and a gram per ton gold, or an ounce per ton gold as well. So
An ounce per ton gold?
1 ounce per ton gold and 300 ounces per ton silver at its highest grade. So between 200 and 300 ounces. Right now at the Midas mine, their head grade is 44 grams per ton. That kind of head grade can take a lot of downward pressure in the gold price and still deliver a profit to shareholders. For every dollar that the silver price increases at the Midas mine now, that adds another $1.3 to $1.5 million per year to the bottom line for the company. So, I mean, the company's in a great position for a recovering gold price, or for a static gold price, or for a falling gold price. And so for investors, I mean, they bought the company with 93 pieces of machinery, with a 1,200 ton per day mill that right now is only running at 600 tons per day. So they've got optionality. They've got their Fire Creek deposit 100 miles away, and it costs them $32 per ton to truck ore from the Fire Creek deposit. So they can ramp up to 1,200 tons per day, but they've got a small problem in that their tailings pond is currently full. They're in the process of permitting for a new one, but it's going to take possibly up to another year.
Very interesting. Thanks very much.
Thank you.
And thanks for being with us. That's one I do not own, but I'll definitely check it out.
It's my pleasure. Thank you, Scott.
Again, that's James West, the Midas Letter. My name is Scott Gibson with Beneath the Surface. Thanks for being with us.